Welcome everyone, thanks for joining. In this video, we're going to be doing some big changes to my portfolio, specifically the Story Fund. I'll show it here. This is the Story Fund. It's a portfolio around $69,000 in value, only $4,500 in gains. So this one hasn't been doing that good, mostly because it's mostly technology companies. So it's a lot of those software tech companies. Those are the type of companies I love to own. But unfortunately, over the past few months, as we've seen, tech companies have seen a huge sell-off, especially software companies. Investors have said, we've had enough of these companies. They raced up to really big multiples, and they sold out of them in favor of value companies. So the S&P 500 has done really well. It's beating my portfolio, the Story Fund, by a decent margin right now. It's up 16%. My portfolio is up 9.6%. So the S&P 500 is up around 7% above my portfolio, and I don't like this. I want to catch back up. I don't think I'm out of the game right now. I think I can catch up over time. So we'll see how this goes. But I am making some big changes. I'm not selling anything. So that's the first thing I want to say. I'm not selling out of any holding, but I am adding in quite a bit of new holdings. And I'm going to be changing the allocation of every holding and the weighting of them. So the way that I have the specific weighting for every holding is going to be changed quite dramatically. Now, let me go ahead and explain the way that I plan on doing that. I'm going to be using a tier ranking system where I rank every single holding into 4 different categories: the most stable, which is big tech, the blue chip mid tech, which is a step below big tech, and then we just have mid tech, that's a step below the blue chip mid tech, and then we have speculative tech. So these are all technology companies. This is mostly a tech portfolio, but these are 4 different categories of tech companies. And I have every single holding in the portfolio, every single company, and I'm going to assign them to one of these 4 categories. And then based off of these categories, I'm going to assign every holding a weighting. So big tech will make up the biggest weighting per holding. Blue chip tech will be right underneath that, and then so on and so forth till we get down to speculative tech. So I'm going to be going over all of this. I'll be going over every single holding. I'll explain why they belong in a certain category, in my opinion. You can tell me whether or not you agree, but I think this will be a lot of fun. This will determine the construction of my portfolio, the specific weighting of it, and how I plan on introducing or adding new holdings in the future. So I'll give you the finished product at the end with a link of the new portfolio, as well as we'll be going over every single holding and explaining why I believe they fit in these categories. So should be fun. We have a lot to jump into. Let's go ahead and get started. All right, so here we are on the tier ranking list. Like I said, we have the 4 categories, and then we have the companies underneath, and I'll be assigning each of them to one of these categories. Now, before I start doing that, I want to go over and give a quick definition of the 4 different categories so we really know what these are. And I'll start off with big tech right at the top. Big tech is, well, they're the best companies in the world. Bar none, no argument. They are the best companies in the world by far. And by the best, I mean they're the most powerful, the highest quality, the most diversified. They have the most income. They have the most talent working for them. They cannot be stopped by other companies. Other companies can only be bullied by them or be absorbed by them or be crushed by them. So other companies most of the time complain about big tech because they have no power over them. They can't do anything about them. They can't penetrate the moat. They can't take market share from big tech. All they can do is struggle to survive or work alongside big tech. That's how powerful big tech is. They're the best companies in the world. Big tech is so powerful that even governments have a difficult time dealing with them. That's how powerful they are. The US government can't stop big tech. They bring them to their congressional meetings and they yell at them, but at the end of the day, they can't do anything about it. Europe tries to stop them sometimes by fining them, but that's the most they can really do is shave off a few billion here and there. But for big tech, a few billion here and there doesn't mean much because they make hundreds of billions of dollars. So that is big tech. They are a step above every other company. They are the best companies in the world. Underneath that, we have blue chip mid tech. So I have 2 categories of mid tech, one that's just mid tech and one's blue chip mid tech. So the defining difference between this secondary category is that it's blue chip. They're both mid tech, but this one's blue chip. If you don't know what the word blue chip means, this is an important definition to know if you're an investor. Blue chip means, this is by Investopedia. Blue chip means that it's nationally recognized, well-established, and financially sound company. So a nationally recognized, well-established, financially sound. Blue chips generally sell high quality, widely accepted products and services. Blue chip companies are known to weather downturns and operate profitably in the face of adverse economic conditions. In a way, blue chip companies are, they're basically resilient companies. They have strong balance sheets. They sell quality products, and they can survive and even sometimes thrive in all different types of environments. High interest rates, low interest rates, booms and bust. Blue chips are the ones that end up surviving. They're the ones that are strong enough to do that. So if you think about blue chip companies, what you're thinking about is secure, predictable revenue streams and a secure and predictable business. That's what is the defining attribute of a blue chip company. Underneath blue chip mid-tech, we have other mid-tech companies, which mid-tech is a size. It means that they're not quite as big as big tech, right? They're not at that size, but they're pretty big companies. So blue chip are companies that are very stable, mid-sized technology companies, very, very secure companies. They have cash flows, they have reliable streams of income. That's blue chip mid-tech. Under that with mid-tech, you have companies around the same size, but they're not at that status quite yet of being blue chip. They want to be blue chip. They're trying to move towards that, but they're just not there yet. They're a little bit more unstable. They're not quite as predictable. And I wouldn't, I think, accurately categorize them as blue chip companies. And then underneath mid-tech, we have the category, it's tough to read here, but it's speculative tech. Speculation. What does speculation mean? What does it mean if you're making a speculative investment? Well, let's again go to the definition here. Speculation is a financial transaction that has a substantial risk of losing value. A substantial risk of losing value. So if you're making a speculative investment, you should be aware as an investor that you run a high risk of losing a lot of money. That is the definition of a speculative company, but you also have the expectation, at least the reason you're investing in it, is because there's an expectation of a significant gain or other major value. So basically what a speculative investment is a high risk investment. You can lose a lot of money. That is a common outcome of speculative investments, but you also have the chance of outperforming and have the chance of the company or the investment going up multiples in value. So it could go up 2 times, 3 times, 5 times, 10 times. That can happen with speculative companies because they're high risk both ways. They can lose value, they can gain value. So speculative companies are kind of the opposite of blue chip. Where blue chip is very predictable, very reliable, speculative is unpredictable, unreliable. The outcome is very unknown, but the reason that people invest in them is because of their chance for outperformance, because of their chance for significant gains. So that is speculative tech. Now, because speculative tech is the least predictable, I have it as the lowest tier on this rating system. So that's the rating system from big tech to speculative tech, the highest allocation per holding to the lowest allocation per holding. That's how I'm going to organize my portfolio. So let's go ahead and start assigning companies. We'll start off right here with Teladoc. Teladoc is a telemedicine company, which is a nice way of saying that you can visit the doctor through your phone or through your iPad or whatever, right? You can do it digitally, like a Zoom meeting, that type of thing. And they can even prescribe you medications. They can do different things like that. And I do think it has a future. It has a lot of potential, but this company is highly volatile. The market cap is around $20 billion, and you can look at the volatility here. It traded up 38%, and then it was almost $300 a share, and it's since traded down 52% to $152 a share. So again, this is a highly volatile company. This isn't the type of stuff you see from a blue chip company all that often, but the company is growing quickly. If we look at the charts here, their revenue is growing quarter over quarter quite rapidly. Now, obviously 2020 sped up Teladoc because of the COVID and people wanting to do meetings more digitally than in person. So a lot of the concern here is that this revenue growth will slow down over time as we move out of the COVID environment. So Teladoc is clearly a speculative company. Not a lot of predictability here with the stock. We know that it can have a lot of volatility. We don't know what's going to happen, but we're hoping this one does well because the reward could be really good if it does. Next up, we have Spotify, the music streaming service. Everyone mostly knows about this company, so it doesn't need some big introduction. What I will say is that Spotify is a fast-growing company. They're growing their monthly active users as well as their premium subscribers. There are concerns with the reopening of the economy that people stop using Spotify. I don't agree with those concerns. I think that growth might slow down a little bit, but I think that the long-term trends of people moving more towards streaming music like Spotify are still intact. I think that's going to continue to happen. Looking at the stock, It currently has around a $48 billion market cap, and it is a highly volatile stock. So it trades up 45%, then it traded down 38%. So this is one that I like having in my portfolio. I think it's a great company. I think it has a lot of growth, but it is a pretty volatile holding. Now, looking at the categories here, I think Spotify could fit into potentially two different categories. It's definitely in mid-tech. The question is whether or not it's blue chip. In my opinion, Spotify is not a blue chip company. So even though it's mid-tech, it's not blue chip, so it fits firmly in the mid-tech category. That's Spotify. It's not quite speculative, but it's not quite blue chip. It's right there in between. Now, after Spotify, we have Apple, which of course is big tech. It's the biggest of big tech. Apple is a globally dominant company. Other companies can only complain about Apple. Every company has had problems with Apple because of their dominance. Microsoft has, Netflix has, Spotify has, Epic Games has, Amazon has had their issues with them. All of these companies have complained about Apple because of their global dominance, their monopoly over the App Store, and over different segments of business. If we look at Apple, they're growing. Even though they're big, they continue to grow, especially their services, which is the aspect of the business that I'm most excited about. They're growing their services 20% year over year, and the revenue from their services is more meaningful because the margins are almost double their normal business. So the margins of their normal business is 30%. The margins of this revenue is about 60%. So it's an extremely high margin business. So Apple's a company that has over a $2 trillion market cap, and it's having less volatility over time. It had some more historically. If you go way back in time, Apple did have a lot of volatility, but more recently the company has kind of matured a little bit, especially with the services, the subscription income. The volatility has lessened quite a bit. Now, I think Apple's, in my opinion, a pretty good deal right now based off the PE ratio, the growth of the company, the moat, the security. But this is definitely a company that belongs right there in the big tech category. And next up, we have Adobe. Adobe is a software as a service company. It has that nice Adobe Creative Cloud. They shifted from their legacy business where they had one-time sales of their software suite for like $1,000. They had a lot of problems with people either just buying it once and holding it for life, right? They'd just buy it once and hold it forever. That way Adobe wouldn't continue to make any money. And also it had a lot of issues with piracy. When you have client-side software, it gets pirated every time. But Adobe has solved a lot of those issues by moving to the Creative Cloud, which is a monthly subscription, and it gives you access to all their various products like Photoshop, Premiere Pro, After Effects, and so on. So Adobe's one of these companies that has this nice subscription income, highly resilient and predictable income, and it grows month over month, quarter over quarter. They gain more and more subscribers, and their subscribers pay them every single month for the rest of their life. That's Adobe. So this is a very desirable business. A lot of companies wish they had the same business model as Adobe. In my opinion, Adobe being a $232 billion market cap and having that nice subscription income, it has a predictable business, which means it is a blue chip mid-tech company. It's not big tech. It's not even close to that status, but I wouldn't just put this in the mid-tech category because it is such a predictable business. It's a highly predictable income. So in my opinion, Adobe has claimed the spot of a blue chip company. It's in that blue chip mid-tech position. Next up, we have this logo right here. This is CLTD. A lot of you might not be familiar with this company because it's in Southeast Asia. It's a lot like the Alibaba or Tencent of Southeast Asia. So it's a newer company, growing rapidly. It's a little bit less predictable. It has currently a $94 billion market cap, so it has kind of a big market cap because of the growth in this company. It's growing in three different categories. Digital entertainment, which is a word for gaming. It's growing in the gaming industry, e-commerce, and then fintech. So those three categories are all rapidly growing categories as we've seen, and this company's in all three of them. So that's why it has a premium. That's why it's growing so rapidly, and that's why investors want to own it. But even though this company has a $100 billion market cap roughly, I still think it's a speculative company because it's not well established. It's brand new. They need to figure the business out to be in that mid-tech, a little bit more secure category. So right now, I consider it a speculative company. You have a chance of losing a lot of money with CLTD, but it also has good potential. So I want to have it in my portfolio. After that, we have CrowdStrike. CrowdStrike is the company with the goal that I love their goal. It's to stop breaches. Every time I hear about another company being held hostage by hackers and them extorting money out of it, makes my blood boil a little bit. So I like getting behind a company like CrowdStrike, where their entire mission is to stop hackers, to stop those pests from hacking different productive companies and compromising their businesses and extorting money out of them. So I like everything this company stands for. I like what it's doing. Stopping breaches, stopping scammers, stopping hackers. That's something I very much want to be invested in. The company's growing rapidly. It is a SaaS subscription model company. It's kind of one of these newer companies that it does everything cloud-based, and they're all about having that residual subscription income. Now, this company I would not define as blue chip. It's just not there. But I also wouldn't define it as speculative. It's a little bit more secure than that. So I'd put it right here in this mid-tech category. So that's where I'm putting CrowdStrike. After that, of course, we have the logo all of you are familiar with, Netflix. This is a company that I'm very bullish on. Everybody knows my bull case for it. I just have so much hope for this company. And I think that what they've already accomplished is going to prove very difficult for other companies. Look at what Disney did. They have probably the best up-and-coming streaming company, right? Disney Plus, and even them are having a hard time growing after reaching 100 million. Netflix is at above 200 million subscribers and at an ARPU, an average revenue per user, that's way above Disney Plus. Disney's is like $4 or $5, right? Because they have Hotstar. Netflix is at what, $12 or $13 a person, right? That is a very high average revenue per user. So Netflix, I think, is above where people are pricing it right now. It's already above where it is. It's still a little bit less known than most companies because there's so many competitors entering into this field. You have Amazon with their videos, you have Apple TV Plus, you have Peacock, you have Discovery, you have Viacom CBS with Paramount Plus, you have Disney Plus, you have HBO Max, so on and so forth. I can name off literally like 10 different streaming services, and all of them are trying to accomplish what Netflix did. It's rare that a company has this many well-funded, well-established big companies trying to get at its market share, trying to replicate its business. Not many companies have this many competitors, a bunch of sharks surrounding it, looking for any type of weakness with Netflix. So even though this company, personally, I think it's great. I love owning this company. I think it has a great future. It has more risk, and I wouldn't consider it blue chip. I would consider this in the mid-tech category. Right there kind of with Spotify and CrowdStrike. It's a good company, but it's not right there with the blue chip yet. I think over time, my opinion is that Netflix will achieve blue chip status. I think it will be right there with the blue chip companies in time. But right now, I can't safely put it there because there's so many unknowns with the level of competition they're seeing. It's pretty fierce right now, but I think over the next couple of years, I think that they will prevail. That's my guess. And I think they'll move up to that blue chip category. After that, of course, we have Square. This is a company most people know about. It's one of those popular kind of hype stocks. If we look at the growth of the company, it's actually pretty impressive. It currently has an $88 billion market cap, but looking at some of these graphs, this is the Cash App monthly active users. So this is a thing that's owned by Square. They own the Cash App. You can see that it's growing. That's good. It's growing really rapidly. You can see that their gross payment volume is growing as well. So Square is being used more and more, and their revenue is also rapidly growing, especially in 2020. So things are looking good for Square. It's a growing company. It got priced up too highly. It came back down to reality, but here we are with Square. This one, in my opinion, is in that speculative basket because although the company is growing rapidly, they have a lot of competitors. It's a high-risk company. You can lose a lot of money in this one. It's not a well-established mid-tech company. It hasn't reached the level of a Netflix. I think that Netflix and CrowdStrike and Spotify are more secure companies than Square currently. Next up, we have DoorDash, the food delivery company. This is a company that connects together the drivers or the dashers with the restaurants and the customer. That's all it does. They connect those three parties together. It's easier said than done. It's a very difficult business. Making the logistics work, making it so you have enough drivers that it's not cost prohibitive to enter into a new market, paying the drivers enough that they want to drive for you, making it so it's cheap enough that the customers want to use the service, and on top of growing the business with marketing, on top of keeping the restaurants happy and local governments happy. Very difficult business, very difficult to accomplish. But that difficulty makes it so that other companies have a difficult time. DoorDash has the lead, and they have a network effect where it's like scalability. The bigger lead they have, the cheaper they can run their business and the more cost effective, which gives them a further advantage. And although this company is growing rapidly, it is firmly in the speculative tech category. I don't think I'm going to get any arguments out of that. DoorDash is about as speculative as it gets. It's extremely volatile. It's in a business that's completely new, very unknown. We don't know what direction this is going to go. It has a ton of risks. It's not even close to a blue chip company by any meaning of that definition, right? It is firmly a speculative tech company. Next up, we have the online retailer, the do-it-yourself retailer. You can start your own store with Shopify. Shopify is a merchant, so they take a portion of every sale on their platform, and they also charge a subscription fee monthly to have their service. So they kind of make money in two ways. They scale in two different ways. They make money through their subscription service. So the more users they have, the more money they're making. And they also make money from every sale being a merchant. So the more those users sell, the more money they make. So Shopify has a ton of potential, a ton of money-making potential. They're becoming more well-established. Not only are small-time businesses and individuals using them to host their stores, but also some mid-sized companies and even really big companies. Shopify is very powerful. It has a huge marketplace of developers on it. It has a lot of support. It has a huge logistics network. It has everything it needs to be a successful company. So, my opinion, it's not in the blue chip category. It's right there with Netflix, CrowdStrike, Spotify. Shopify's in that category of being mid-tech. I wouldn't consider it speculative, but I also would not consider it blue chip at this current point in time. Next up, we have a new holding to the Story Fund. Ticker symbol TEAM. It's called Atlassian. This is a company that I've talked about historically. It is a company that makes tools for developers, and they've gotten to the point where they're now a little bit more established. They have a SaaS business. They're very comfortable in the development world. They have a whole suite of different tools that developers use every day, and they pay subscriptions for them. So Team is a company that has that nice subscription revenue. Again, something I look for in most of these companies, and it grows quarter over quarter over quarter. They're a very successful company in growing the service. Right now, they have a $53 billion market cap. So I don't really consider it to be a speculative company. With the level of stability they have with their subscriptions, the rate that they're going, and the predictability that brings, I don't consider them a speculative company, even though they have a smaller market cap. I would put them firmly in this mid-tech category, in between speculative and blue chip. They're not blue chip yet, but they're not speculative either. I'd put them right in between. Next up, we have Google. Come on, this is big tech. Easy rating for this one. It's about as big as it gets. It has multiple monopolies. It basically has a monopoly with YouTube. That's growing like 46% year over year. I don't know how long they can keep that up, but YouTube's growing insanely fast. And of course, they have Android, which they gave away for free so that they have access to advertise on billions of phones and push their advertising business. And so they have Android, they have YouTube, they have Google Cloud and all their business services. And then, of course, they have Google Search and their advertising business. So this company is well diversified, globally dominant, has multiple monopolies, and it's a cash cow with the strongest balance sheet as they can get. And they're going into all sorts of different stuff like all the big tech companies, artificial intelligence, autonomous vehicles, all the rest of it. So Google is firmly a big tech company. Now, after that, we have PayPal. Of course, everyone knows this business. They own Venmo. They own their merchant service. And they've grown into a very large company. PayPal currently has a market cap of almost $300 billion. So it's a big company, continues to grow. It has one of the most reliable revenue sources ever, which is a diversified, huge network of merchant. And they have a high net income, a very profitable company. This one is a blue chip mid-tech company. It's above Spotify or Atlassian or Netflix. It is a profitable, highly resilient, highly predictable business. It's a blue chip company, but it's certainly not a big tech company. Facebook, on the other hand, is certainly a big tech company. It's the smallest of the big techs. So although Facebook has not reached a $1 trillion market cap, I think they're probably the closest company to getting there. They're going to eventually be a $1 trillion company. They're growing in the foreign markets, the emerging markets. And even though they're saturated, Facebook.com is, in the United States, they continue to grow other businesses and monetize in better ways. So right now, Facebook's biggest concern is like Apple and their kind of war on advertising business. That's what Facebook is facing right now. But this company is a big tech company. Next up, we have Disney. Disney is, okay, you might be saying, Joseph, is this a tech company? Not really. It's not really a tech company, but I'm I'm making an exception. I'm squeezing it in there with the tech companies because, come on, Netflix is a tech company, right? Everybody says Netflix is tech. Well, now Disney has Disney Plus, they have Hulu, they have ESPN Plus, they have all their streaming services. So they're kind of a tech company, even though they have some parks. So you might argue with me on that. I can see the argument. Maybe they aren't tech, but I'm going to make an exception. I think that Disney is a blue chip tech company. Blue chip because of the resilience of their business. The only thing that really hurt Disney was a pandemic. And now that they have Disney Plus, I think they'll have even a better, more resilient blue chip type of business. So Disney's right there. It's one I'm bullish about. I've made a lot of videos and content about Disney, so I won't talk about it much here, but I think it's in that blue chip category. And then we have the SaaS king, Microsoft, which is, of course, a big tech company. Microsoft is massive. They're growing at their current rate. They continue to grow year over year without a hiccup. So this is a growing SaaS company. Every part of their business, you can tell, Microsoft wants to move towards that subscription model. Even with gaming, they have their gaming passes, they have their yearly passes, Microsoft or Xbox Live, they have their cloud gaming efforts that they're doing. Everything is centered around subscription model. They've known this business for a long time. They have their Office products, they have Azure, they have gaming. They have so many aspects of their business that are all in growing industries that are all doing so well. They're led by such a good CEO. I'm very bullish on this company. So it's out of the big tech. I think all of them are good, but Microsoft is a really great company. And then a company that I refer to as mini Microsoft is Salesforce. Salesforce is in that blue chip category. I would not consider it anything but a blue chip company. It's not big tech. It's not just any mid-tech company. It's far more stable than companies like Spotify or CrowdStrike. Salesforce is a well-established business with hundreds of thousands of customers and a highly resilient income. And they compete with Microsoft. They have similar services that they offer, so they're direct competitors, but Salesforce has been very successful. After that, we have Amazon. I'm giving a spoiler alert here. This is the last of the big tech companies. Amazon is obviously big tech. They're going to remain in that category, I think, for a long time. But they are a business that I think, with all of these businesses, big tech, I actually think they're all at decent valuations right now. So it certainly belongs in that category. After Amazon, of course, we have Mastercard and Visa. These are two new holdings to the portfolio, two that I'm introducing back into the portfolio, because I just think that I need to have these companies. They're such good companies. They both have a giant network of payment services, and they do the authorization, the clearing, the settlement of transactions all throughout the world. Anybody that wants to accept digital payments links up to these services, and then they allow them to do that easily. So it's very difficult to replicate what Visa and MasterCard have done. They have a duopoly. They have so many merchants using them currently, and they're so seamless, and they have so much insurance when they authorize and they settle these transactions that it's just difficult for other companies to compete. And that's why these companies are firmly in this blue chip mid-tech category. They are not just mid-tech, they're in the blue chip category. After that, we have Peloton, which is speculative. This company is growing rapidly. I have a very bullish take on it. I think that there's a good chance it could be a sustainable business with its subscription income, with its enthusiastic consumer base that has remained enthusiastic year after year. There's a lot of competitors trying to take market share. There's a lot of possible bad outcomes for Peloton, right? They have a lot of volatility. They have a lot of risks, a lot of competitors, but I do think there's a lot of upside. But Peloton right now is a very volatile stock. The outcome is very high risk. So this is definitely a speculative investment. And so is the Bill Ackman Pershing Square SPAC. We don't even know what this company is. So it's a SPAC. We don't know what he's going to do with it, if he's going to find an acquisition at all. But this is me buying a SPAC. It's 1% of the portfolio. It's in the lowest tier, which is speculative tech. Hopefully it's a tech company. I think he was planning on going over that, but we don't know. So that is the rating. We have the big tech category. We have the blue chip mid tech. And then we just have mid-tech companies that haven't quite reached blue chip status. And then we have speculative tech. Now, I want to know your opinion. Do you think that I accurately rated these companies and put them in the appropriate categories? Let me know what you really think. You can be honest. If you think that one of them is in the wrong place or it should be bumped up or bumped down, I'll listen to the feedback and I might change around the weighting and the categories of these companies. But right now, this is how I see it. This is where I see the most appropriate category for all these different companies. Given their risk and the volatility and the different attributes with the company, I think this is the most appropriate. But if I get a lot of feedback, I'm totally open to suggestions. Now, each one of these categories, like I said, is going to be assigned a different weighting per holding. Big tech, I'm going to give around a 7 to 8% weighting for each of these holdings. So each one of them, in my opinion, are great companies and they're trading at good valuations. So I'm giving them a 7 to 8% weighting. We have the blue chip mid tech, which is going to be given around a 5% weighting. We have mid tech, one step below that, which is going to be given around a 4% each. And then we have speculative tech, the most high risk, which I'm going to give around a 2% weighting to each. Now, what that results in looks like this. And I'll share this link in the description if you want to look at it yourself. But we have the portfolio here. We have Google, Facebook, Microsoft, Apple, and Amazon all around an 8% weighting. Then we have Disney at 5%, Visa, PayPal, Salesforce, Mastercard, Adobe, and Atlassian all around a 5% weighting. Those are the blue chip mid-tech companies. Then right below those blue chip companies, we have Netflix and Spotify at 4%, CrowdStrike and Shopify at 3%, and then we move into the more speculative companies with Square, Teladoc, CLTD, DoorDash, and Peloton all at 2%, and then the Bill Ackman SPAC at 1%. So this is the way that I'm ranking these companies and the way that I'm categorizing this portfolio. And then what I'm going to do is I'm going to literally just turn on auto fund or auto deposit, just fund the portfolio and let it fill up these companies according to their allocation. So I'm going to start doing deposits and just filling this portfolio up, and all the new holdings that I don't have any money in, those will be filled up first. So that is the changes that I'm making to this portfolio. I've picked out what I think are the best companies in the world, the best tech companies in the world. I've categorized them into different baskets, and I've signed different allocations according to those baskets. I think it might be a fun way. We'll see how this turns out. I don't know whether this is going to perform good or bad, but given the quality of these companies, their subscription business models, and the way that I'm weighting the portfolio, I think it might turn out well. So we'll see how it does, and let me know what you guys think. If you enjoyed the video, be sure to like it, subscribe to the channel, and I'll have more updates like this in the future.